99 crypto companies are dead in 2026. BitMEX, the exchange that literally invented the crypto perpetual swap, is switching the lights off in September after 11 years. And crypto rank data suggests several billion dollars of venture funding for crypto projects of all sorts is buried in that graveyard with them. Now, almost everyone is reading this as the bear market getting worse, but actually at this stage, that's the totally wrong way of looking at it. Because if you look at the causes of death of these crypto operations one by one, you find something really interesting. When it comes down to it, these are businesses that simply ran out of customers or ran out of runway. Easy money stopped flowing, and everything that only existed because of easy money is getting cleared out of the market. So today, we're going to look at what actually killed these companies, why this bear market looks so different to the 2022 bear market, and why this is all just part of a completely standard bottoming process. My name is Lewis, and this is the Coin Bureau. Now, let's start with the biggest name on the list, BitMEX. On July 23rd, HDR Global Trading announced it was winding the exchange down, with full closure on September 23rd, 2026. From August 26th, users go reduce only, and anything still open on the final day gets liquidated automatically. But when you read the announcements, you notice that there is no shocking detail. No insolvency, no hack. Assets exceed liabilities, and withdrawals are open and functioning smoothly. This is the exchange that gave the industry the perpetual swap, the single most traded product in all of crypto. But by the time it announced its own funeral, daily volume had reportedly withered to around $400,000. That's under 0.01% of the market. Binance ate the top, Hyperliquid ate the bottom, and the product BitMEX invented became so commoditized that inventing just didn't count for much at all. And sure enough, the BMEX token fell over 90% on the news. But BitMEX isn't alone. We also have Storj, which filed Chapter 11 bankruptcy on July 26th. But there is a bit of a difference here. The decentralized storage network is still running, still serving customers. What killed the parent company was legacy debt from its 2024 acquisition of a GPU firm called Valdi, a company that raised roughly $35 million total, taken down by liabilities, somewhere between $1 million and $10 million. Now, for what it's worth, I should mention that there is a restructuring plan, which proposes handing equity in the reorganized company to management, investors, and Storj token holders. But in any case, this is another case of a big crypto name winding down. Then we have the regulatory casualties. AscendEX shut its doors on July 1st, the exact day MiCA came into full force in the EU, after failing to secure authorization and watching a liquidity deal fall through at the same time. EXMO was designated by the UK's Foreign Office on May 26 over alleged Russia-linked flows, which paralyzed its banking and custody rails. Its wind down came on July 14th, 29% of user funds unavailable, partly frozen by third parties under those sanctions, and partly never recovered from a hot wallet hack back in December of 2020. So that one's a mix. Government freezes stacked on top of an old theft that wasn't cleaned up. But still, another one bites the dust. Then we have Movement Labs, which filed Chapter 11 in Delaware on July 15th, having raised $141 million, with the Move token down over 99% from its high. And then there's the Runway cohort. Odos shut down July 30th. Dango, whose L1 goes fully offline on August 13th, killed by a $3.6 million seed round meeting a $1.9 million exploit. Leap Wallet discontinued. And one of the most bizarre ones, Entropy, the custody startup that raised around $27 million and in January handed what was left back to its investors rather than burn it pretending. Refreshingly honest, though. Now, let's step back and consider all of the names that I just went through. Not one of those is a matter of missing customer funds or some other major scandal. And that's the difference between now and the last bear market. Because 2022 was very different. It was a series of massive frauds. FTX, for example, was in major crime mode with rehypothecated collateral and a secret trading and borrowing exception for Alameda. Celsius was telling depositors their money was insured while funneling it into unsecured loans, and Alex Mashinsky is now serving 12 years for it. One failure detonated the next, and the shrapnel took out Silvergate and Signature, and creditors waited years. Now, to be fair, those estates have actually recovered better than anyone expected, with many creditors receiving their claims in full. But the craziness of the fraud and market wipeout is what's important here. 2022 was contagion, interlinked balance sheets pulling each other into the hole. In contrast, 2026 is closer to rationalization. Independent companies, individually unprofitable, closing in an orderly fashion with the withdrawal button still working. They simply had no fee revenue, couldn't afford compliance, and the cheap capital dried up. Now, there is one messy case worth mentioning, and its name is BitMart. On July 26th, BitMart announced its own wind-down, trading ending August 26th, full closure by January 31st, 2027. But reports suggest only 63 withdrawals were processed in the first 24 hours, with nothing over $25,000 going through. Global CEO Nenter Chow says he was terminated on July 24th, 2 days before the announcement, and found out about the shutdown the same way you did. He publicly criticized the whole process, saying he was cut out of the decision entirely. And sitting underneath all of it is a roughly $196 million hot wallet hack from December 2021 that was never fully resolved, with no comprehensive proof of reserves published before the shutdown. But nevertheless, BitMart is the exception here. One ugly case out of 99 does not make a systemic crisis. But you can only be confident in that if you're analyzing the reserves, the filings, and the revenue every single week. And if that sounds daunting, or you simply don't have 16 hours a day to sit glued at a screen, we've made it a lot easier. Because right here on YouTube, you can now access the new Coin Bureau Club Lite plan. You'll get direct market updates across both crypto and TradFi. Our teams read on the best opportunities and curated updates with only the bits that actually matter. Just tap that join button below this video to get started. And now let's get back to the wreckage. Because the second wave of forced selling comes from the companies that spent 2 years telling you that they would never sell. Those digital asset treasury companies, or DATs. Now, just in case you're not aware of how these things are structured, I'll run through it very quickly for you. A treasury company trades at some multiple of the coins that it owns. That's called MNAV. Above 1, the market values the company at more than its stack. So, issuing new shares to buy more coins actually adds value per share. Money in, coins in, share price up. Repeat the process. Below 1, though, the whole thing runs backwards. Issuing shares now destroys value, so the buying typically stops. And when the buying stops, the only thing left is the coins. Strategy used to trade between 2.5 and even 4 times its Bitcoin. It's now hovering between 0.77 and 1.01, while the company holds about 843,000 BTC at an average cost basis of roughly $75,000. In Q2 alone, that produced an $8.32 billion loss on digital assets, of which $8.31 billion was unrealized, flowing straight through net income. The stock is down 37% year to date as I make this video. But then came the part nobody thought that they'd actually see. In late May, Strategy sold only 32 Bitcoin, but it was its first sale in 4 years. And then, between June 29th and July 5th, it sold another 3,588 Bitcoin for $216 million to cover preferred dividends. On June 29th, it formalized a digital credit capital framework authorizing up to $1.25 billion of Bitcoin sales. The never sell doctrine died because the market forced Strategy's hand. But Strategy is far from the worst off here. Metaplanet, for example, sits around 0.90. Nakamoto around 0.92. Bitmine is at 1.01 on 5.67 million ETH, balanced right on the line, held up by staking yield. Roughly $62 billion of digital asset treasury market cap evaporated in the June downturn alone. But this is a finite overhang with a published holder list. We know who owns it, how much they own, and roughly why they'd sell. These are forced sellers who bought at the top, which is the textbook definition of a bottoming process. And that brings us to a very important question. If capital left crypto during this bear market, where exactly did it go? Well, one of the clearest answers to that question can be answered by crypto miners, because they didn't shut down. Instead, they just simply converted. Mara sold 20,880 Bitcoin in Q1 for around $1.5 billion. Riot sold 3,778 Bitcoin in a quarter, where it only mined 1,473. Core Scientific liquidated 1,992 Bitcoin in March, about $175 million, specifically to convert 300 megawatts to AI. Bitfarms rebranded to Keel Infrastructure and announced a $161 million Bitcoin sale to fund a 96 megawatt campus in Quebec. BitDeer sold its entire treasury. Meanwhile, hash rate is down 22% from the October 2025 peak, and daily mining revenue is down about 40% year on year to about 28.5 million. So, miners were selling, but look at what they were buying. TerraWolf signed a 20-year, $19 billion lease with Anthropic. Hut 8 signed a 15-year deal worth $9.8 billion. Public miners have now disclosed over $70 billion in AI and HPC contracts, and CoinShares projects AI could be 70 to 80% of major miner revenue by the end of this year, up from 3 to 5% in 2024. The economics behind this explains everything. AI infrastructure costs $8 to $15 million per megawatt against $700,000 to $1 million for mining. So, a bunch of crypto's bear market is actually an AI capex bull market. The capital simply rotated. And that changes the fundamentals behind sell pressure entirely, because that's coins being sold for a funded, specific purpose with a construction deadline as opposed to simply market panic. Although it is worth pointing out that Van Eck thinks that there's a $50 billion funding gap across those promised builds. So, if financing tightens, some of these miners could be forced back to the well. Something definitely worth watching.
What if you could trade real US stocks like Apple, Nvidia, or Tesla without leaving your crypto account? Well, that's the idea behind our tokens from BitGet. These are tokenized stocks backed one-to-one by real shares, but the key difference is they are actually usable. You can trade them, use them as margin, and even earn dividends instead of just letting them sit in your wallet. So, if you want to check them out for yourself, sign up for BitGet using the link in the description or by scanning this QR code.
Now, at this point, you might be wondering where this actually leaves us and the market. Well, let's dig deep into some data to see what's up. Long-term holders now account for 43% of all realized losses, up from 15% in February. In one 48-hour stretch in June, $2.4 billion of long-term holder losses were realized. Short-term holders are roughly 18% underwater on average. So, the people selling at a loss right now are the people who held through everything else. That cohort doesn't capitulate twice. Exchange balances have fallen to a 7-year low, around 2.21 million Bitcoin. Coins walking out the door while the price falls, which is the opposite of what panic looks like. Though I'll add that some of that is liquidity concentrating into the biggest venues, not purely cold storage. Perpetual funding is sitting around neutral, meaning the leverage has been almost entirely purged, and the reflexive liquidation engine that can make crypto so violent simply isn't loaded anymore. And the ETF saw a record $4.5 billion outflow month in June, followed by a 7-day net inflow streak into late July. And that's what an exhausted seller looks like. But before we go full euphoric, I'll point out some data that suggests maybe we're not fully out of the bottoming process yet. At roughly 51% below the 126K high, this drawdown is still shallow. 2022 was 78%, 2018 was 84%. And on time, we're around 280 days from the October 2025 peak, against 385 and 381 days in the last two cycles. The argument is that ETF and Treasury buyers cushioned the fall, so the pain was never severe enough to force a proper flush. but that means the real one could still be ahead. But the shallower drawdown is precisely what a market with a permanent structural bid looks like. The final flush isn't necessarily missing. It could be paid in installments by long-term holders over months instead of one violent week. Now, I'm not going to give you an exact price target, and anyone who does is guessing for the most part, but the precedent is on the record. Bitcoin buyers at the 2018 bottom saw over 2,000% gains across 36 months to a new high, and 2022 buyers saw over 700% across 24 months. Right now, crypto companies are dropping like flies while crypto prices remain depressed in big drawdowns from all-time highs. This is the stuff bottoms are made of. But what do you think? Is this wave of shutdowns a washout that clears the way for the survivors, or is this recent wave of closures the beginning of something much bigger? Let me know your thoughts in the comments down below. And if you want to understand what actually separates a protocol with real revenue from one that's running on fumes, well, then you should definitely check out our video on that and what makes a solid crypto project right over here. As always, thank you all so much for watching, and I'll see you again very soon. This is Lewis, signing off.